I just like that it makes me look better. When Brock's late, I look better because I'm going to be late at some point in the future. I was, late once or twice.
What's more sort of humorous is our special guests are late as well. So let's, I'm going to send them.
It's all good. That's what we're here for. We hold down the fort. I mean, one of the things I missed out on was Shinola is a luxury brand, watch brand in Detroit. And they did a special drop of a watch. And I'm not a watch person. They did a special drop of a watch that was every time around the face of the watch said late instead of a number, just said late, late. And that's me. I have kind of my own timeline, and it's a bad habit.
So is Brock just getting too big for his britches here? I don't know.
I think he is. That's what it is. Obviously, he's got,
Well, I think, Kirill, you've just been promoted to the third person for Real Friday. It's on Friday. Brock Cassidy, who is been sort of, for lack of a better term, founding member of the group here for.
For lack of a better term, he was part of the founding.
I mean, when I say
because he's late doesn't mean.
Here's classic Brock. So Brock's on, but his camera is broken. It's not coming on. Oh, here it is. So he just joined. So Brock is the chief revenue officer for a company called NewZip. So he kind of super smart tech innovator guy. He's on the younger end, right? Jeremy's older. I'm in the middle, and Brock's on the bottom end. And so Brock, but super smart on real estate tech and all things mortgage tech. But he's had some really great wins and great traction with his company NewZip. And then Jeremy, is very similar, right? He's a lawyer. I've met him when he was running a kind of a retail wholesale platform out called Norcom out of Connecticut. But he was running kind of the legal compliance, kind of cutting his teeth in the business. I don't know. Where were you prior to Norcom prior to that?
Law school, pretty much. I had.
That was your first foray.
I got a firm job, like at a law firm in Hartford, doing consumer protection, CFPB type stuff for financial services companies, but it was a contract position, hourly contract position. It was not like a true tenure track or partner track type of thing. So when I got the chance to go in-house at a mortgage company, I did.
We see you, Doug. We see you.
Hello.
She's like, pay attention to me
without interrupting the conversation.
No, that's all right. So we have real estate tech, for lack of a better term, with Brock. We really have title and sort of fulfillment tech with Jeremy and legal. Now, granted, there's a ton of I don't want to do Brock a disservice because Brock's had his hands in a lot of tech innovation, both at Rocket in his advisory capacities with other tech incubators, working with lenders. And then myself, I'm really more of a front end M&A retail guy, right? So I've worked with retail mortgage lenders across the United States, helping them acquire other companies, grow organically through organic horizontal growth, as well as sort of vertical growth. I've raised a lot of capital for companies. I probably more 10 years ago, I focused more on tech because I was on the LOS side, and then sort of graduated onto consulting with tech integrations and just making platforms talk, right? But as I grew in my business, as Jeremy and Brock's business have grown, it's when we try to solve these small micro problems, it tends to sort of evolve into, the broader workflow of the operation and where these efficiencies can really take place. And one of the questions I had for Jeremy as we were going into this was like VOE and VOI. Like, this is crazy. Like, where's the real innovation in technology? We've been pulling VOE and VOI for 4506Ts and tax transcripts and everything else, like, for the longest time. Like, is there really room for innovation here? And Jeremy, your comment was really smart, and I forget what it was. What was it?
I just said the innovation is challenging the status quo. Whether that status quo is the provider historically of, let's say, employment data, or whether that status quo is using new data sources to make a determination. So I have a bad habit of jumping way ahead, right? I want to geolocate cell phones and if your cell phone is in your home office from 9 to 5, 5 days a week, we have a pretty good indication that that's where you work, right? Like, there's a lot of ways you could do employment in different technology streams, but the reality is what's going to be documented, what's going to fit into the ecosystem, what are lenders going to adopt, and once you get into all that, you whittle it down to just like, Rick likes to call it innovation, but it's just like a step in the right direction.
Yeah. So I think that's a good sort of lead into Kirill and Darshana, right?
Yes.
From Truv. So you know what? I think I even I missed a letter. TRUV. Sorry.
Let's maybe not worry about the Chiron so much and just have the conversation.
Yeah. So tell us, like, how did you get started, Kirill, in Darshana, with where you saw the opportunity in tech and for the lender today in your product? So give us a little bit about your history and the product.
All right, the story is very straightforward. I came to US to go to business school, graduated, tried to get a loan, didn't have much of a credit score, got rejected by 5 banks in a row, including my credit union where I was banking when I was at Stanford. And that felt like very wrong. Like, why would they reject me? I'm perfectly fine. I have a job. I'm paying my bills. Why wouldn't you take me on? And that was really seeing that firsthand and sending like pay stubs back and forth and W-2s and then getting lost somewhere in this big organization was a very frustrating experience for me. So a few years later, when I looked at how can this problem be solved, we came with the idea that we should aggregate the payroll data. And like Plaid, VOA has been solved for a little while. There are like multiple companies that do. I think the most common, well-known is Plaid. So we built sort of Plaid for payroll. And then when you start building Plaid for payroll, you talk to customers. And this is where Darshana comes in. We spoke to so many customers that say, hey, I don't want just payroll aggregation. I want 2 things. I want you to solve my income and employment, and I want to solve like generally all of my verifications. And that's where we're heading, right? We started with payroll aggregation. Now it's Friday certified. Darshana, how am I supposed to say that? Approved by Freddie for AIM. And the plan by the end of next year is really complete the picture. So instead of you buying a point solution from us, you can buy a complete solution for verification of assets, verification of income and employment. And the payroll aggregation is, when we started, we thought like, okay, it's going to be as easy as bank to build. In reality, payroll is much more complicated than any bank transactions. And we're 3.5 years in and we're still building it. It's like every day is something is different than the other day. And there's a lot of ways you can make money. And there's so many ways you can spend your money, which is mostly coming out of your bank account and your credit card. So that's where we are today. We're mostly working with lenders today. So we have quite a few mortgage lenders that use us, and we have quite a few personal lenders, including the biggest ones that use us for verification of income and employment.
And to add to Jeremy's point, you asked earlier, how do we innovate, right? The current solution that we provide, it's instantaneous, right? Consumer is in the loop, consumer logs in and authenticates and provides access. With their consent, we take the data, which is updated to the second because we're getting it directly from the source. So there's no fraud, there's no risk. We eliminate any lag and we get all the data and send it back to the lender at that instant. And with innovation, why stop at payroll, right? You could get data from, to Jeremy's point, what he was saying, right? There's so many ways of slicing and dicing the data. And right now, I think there are certain regulations that we need to abide by, but let's question the status quo and ask the basic questions. Can we innovate and get data from bank aggregation? Could that be used for mortgage? Can we get it from elsewhere, right? Why stick to the old ways of doing doc upload or manual calls if we can eliminate that, get it directly from the source, get it from the consumer? It's easy for the consumer. They are high intent. They want this to happen because they have a goal and they benefit from it. And then lender gets accurate information directly from the source and it's win-win. That's how we see it.
So one of the things that it seems like is always the missing link for me is we have technologists, we have the technology to apply it to a particular data feed, even a document, whatever. And then we have this logical leap that investors have to make or underwriters have to make, which is like, oh, well, we have that ability and we have that visibility, but either we haven't seen enough of it or the edge case becomes the barrier. How do you navigate when you say, look, we have all these new ways of looking at this, let us do that, and then we can give you all this feedback? And like, well, we can't let you do that because it doesn't work for one person or it doesn't work for one type of person. You're like, yeah, but it works for 85% of Americans. How do you balance some of the typical obstacles the establishment throws at you, that the status quo throws at you? And did I get them right? I mean, what are some of the barriers? And then how have you been navigating them since you launched?
I think that specifically income and employment, right? The edge cases are very common, right? Like some folks are saying, I'm commission only. I'm like only employment, or I'm an employment and commission. I have specific, like where like 30% of my, say, of somebody's income goes to alimonies. There are ways to read that data and structure it. And I think with investors over time, you just need to take a slice of the data that everybody's comfortable with and work just with that data. And then over time, kind of like, as you see the data trickling in, everybody gets more comfortable with the rest of how you handle all of the use cases. I haven't seen it that much to be of an issue with our solution. Mm-hmm. There's no, like, status quo is primarily like instant database, like the work number. If you take the work number, they're solved maybe 25-30% of the problem anyway. So I haven't seen the challenge with convincing the lenders to use it. I've seen the challenge of like getting the investors or Fannie and Freddie specifically be comfortable with the data source. And that took us about 2 years to get to a point where we are today, where we got approved by Freddie, and hopefully we can get all the other certifications done soonish. So, and that requires deep work and deep integration with both GSEs.
Now, is that the source or the validation? And what I mean by that is, or maybe it's both, but when you think about connecting to new data sources or connecting to data sources that we already have lenders connecting to just for different reasons, is it that they have to see that your company is valid as the infrastructure and connective tissue? Or on top of that, it's also that you do something to the data that they need to make sure they're comfortable with? How do you think about that?
It's both.
Okay.
When you have a new data source, in data management, data engineering is called ETL, extract, transform, load, right? Extracting the data is the first piece. Like, how do you read the data from the data source? Do you read the data off of a pay stub, or do you read it through an API? Do you read it off of W2? How do you read it? What are the tools you use? So once you extract the data, then you sometimes need to transform the data. For example, if you the system doesn't explicitly say somebody has not been working there is not working there, but you haven't seen pay stubs for the last 6 months, it kind of gives you an idea that maybe the person has not been getting paid for the last 6 months, right? So that probably also means the person has not been working there for quite a bit of time. And all of that logic you need to get folks comfortable with. And then finally, when you load, is how do you represent this data in a way that loan officer and the investor get comfortable with? And that's where, like, kind of this 3-step process, you need to get everybody around your solution comfortable with both how you extract the data, are you allowed to access the data, what's the legal framework you use, how you transform the data, and like how you deduct things like somebody was not employed for the last 6 months because they haven't been paid, and then how you present the data so that it becomes user-friendly. It's a challenge. It's a 3-step challenge which you solve. Again, in our business, it's nice because you can find one lender who needs just one integration, and then you can perfect it with them, and then you start adding more and more. And that's been how we started. by now we have 13,000 integration. It's really hard to catch up to something that we've done, but we started with just one or two.
I was going to say, what year did you guys start? Was it 2021, or it looks like you guys raised capital in 2022?
We raised capital first in end of 2020. I think we announced in 2021, and then we raised again in late 2021.
So you raised capital in
2020. Or late 2020.
Or in 2020? Late 2020.
Late 2020, like September, I think.
I was going to say that's either like the best time or the worst time, but obviously it was the best time for a lot of fintech companies to raise a lot of cash. It looks like you guys, and this is, I'm not saying anything inappropriate, nor is it proprietary, but I mean, it's on your website. You raised $28 million in just Series A, or was that your Series B funding, or what was it?
We raised, I think, forgive me, it's been a while, for $3.5 million, I think, in seed, and then 28 in Series A, or 25. Yeah. Sorry, 25 in Series A.
Yeah. In what it's such an odd, I don't know about Brock or Jeremy, but in all the area in the space of innovation, especially given Darshana's background in payments, I would have thought the exchange of money and payments would be a better place to start than just verifying like existing lanes of communication or existing lanes of verification, right? Because there's already specific tracks around validating employment and verification. Now it sounds like you're just doing it better and more reliably and presenting the data differently and more flexibly for lenders for underwriting decisioning. But it seems like payments would be a great path forward for you guys as well, just because there's so much innovation that's low hanging fruit in the way that appraisals are paid, home inspectors are paid, the lenders are paid, and even mortgage payments, quite frankly, are paid. But is that sort of the trajectory, is to kind of focus on verification of income and assets and then actually collection of income and assets, or how is that stretch?
We're so far away from it. You're right on point. That's where if you know how much you're making, it makes sense to collect some of it, right? Or help facilitate the collection.
Yeah.
I think the challenge is the people who are on the right are usually not the people who service, so you have to somehow pass that along. And in lending, everywhere in lending, it's roughly the same, unless you work with a big bank, and then even then the systems are usually not the same system.
Yeah. What is the market share? Jeremy, do you know the market share for verification of income and assets? Like who actually occupies that space? Like as far as like the dominant players?
You're talking about two different things, because there's access to the data, right? So Plaid was already mentioned as like somebody, a company that came out early. You think Account Check, Plaid, and Finicity. Some people will throw Yodely in there as the original three, but that was just infrastructure. Like there wasn't a ton of insights. There wasn't a ton of calculation. There wasn't the way we were just talking about how you process the data or how you structure the data for our industry. It was just like, here's a pipeline. Here's the window on your My Account screen to pipe it in. So I think we're kind of talking about that as a category. Then you're asking about, I mean, Work Number was mentioned. I would assume prior to Truv entering the market, Work Number was 99%, other than manually picking up the phone and calling the HR department one at a time at a credit union.
Which there was quite a bit of.
And so what we're seeing, I think what I'm hearing is like actually the collision of one-off solutions becoming holistic enterprise-wide solutions to do everything that three different companies used to do.
Income, the Work Number, if you're also familiar with them, it's like the fintech that brings in about $1 billion in cash. And I would argue if it was a standalone company, it's probably going to be as valuable as Equifax itself. It's a massive business to do $2.5 billion in revenue every year, and it's just income and employment. There's some other adjacent businesses, but it's primarily income and employment. Assets is much less common. I think that Plaid would be the market leader, not in mortgage, but in mortgage it would be Finicity, Account Check, and others. But the bank aggregation became quickly a commodity. In the last 5 years, it went from having something very technologically challenging to pull off, and now you can just go to a bank, sign the contract, and it will give you access to their APIs. So that has changed quite a bit. With payroll, it's not the same because the Work Number has exclusive or semi-exclusive contracts with quite a few payroll providers. And if you don't pay the Work Number, there's no way you can access that data. Unless you pick up the phone and make a phone call, and even then the Work Number protects that by saying, well, HR teams, if somebody tries to call you, send them to the Work Number. And the story was actually how I learned about the Work Number is like I applied for a mortgage, got a mortgage, and on the closing statement, I saw a $350 closing, on the closing statement, $350 charge from the Work Number. I asked what was that. I realized that it's kind of funny that I applied for mortgage. Somebody took my data at that time it was Paychex, put it in some third-party database, which I didn't agree to, then run the database on behalf of me just checking a checkbox. The lender got charged, but because lender thought like this is too much money, $350, like I don't want to pay for it. So they just put it on my closing statement. And as a result, I paid for somebody using my data without my explicit authorization.
Consent, yeah.
It's just so weird that this is possible, but that's how the state of the state is today. And we're rapidly changing that. We are moving away from the idea that you have to buy data from some third-party intermediary or middleman, and instead you can just partner directly with the borrower and get the data from them.
How are you thinking about, so when you mentioned like we need to change this, there's a better way. I think the two things that have always kind of been in conflict are the now, next, later strategy versus coming in with a net new approach. So I apologize if I broke up there. I had a little bit of a screen issue. I don't know if my audio did or not, but now, next, later is like a roadmap. I need to do this to get here, to change this, to ultimately see. And then startups tend to get potentially lost if the first or second thing is really lucrative. You never make it to the end because it's like, oh, well, I can just make enough money off of the Work Number, for instance. How are you thinking about now, next, later, and truly staying on that path to change things for lenders and lower the cost and unlock the consumer rights that you're talking about versus I just have to come in with a whole net new approach, and then that'll be the thing I pull companies away from the establishment or the status quo. It's always a tough balance, and so I know it's probably a little bit of both. But how are you thinking about it when you plan?
I'll talk about the vision gap, obviously.
Yeah.
And look, when you talk to customers, they tell you, I don't want to buy one thing. I want to buy the whole thing. I want to buy a wheel. I want to buy the whole car. It can get me from point A to point B. So that's always been the vision. And the vision gap is literally what's the difference between solving 100% of all the problems of our customers and what we have today, right?
Yeah,
and
right.
I guess Darshana can talk about the roadmap. She's the mastermind behind like how to build all the things in the right sequence. But the vision is why don't we solve 100% of VOA, VOIE, and verification of insurance? That's currently the vision for the mortgage. And Darshana can talk about how she balances the me wanting everything right now and actually is something that makes sense technologically and product-wise.
I mean,
she'll talk about when she's going to cut in payments. But so give us the product roadmap.
I think we've been trying to stay focused on what we want to do, and Kirill actually talked to it. His seed deck always said like building that 360-degree view of the consumer, and we've stayed true to that vision and making that vision possible. I mean, in a nutshell, it's ruthless prioritization. People don't like me internally because I always ask the hard questions and I give grief to like people to execute on it. So, but that keeps the team honest, right? We deliver on things, we deliver on time. We have OKRs which we look at like monthly, weekly. We obsess about it, and both Kirill and Ilya, both our CEO and CTO, right? Kirill is here, CTO is missing here. They kind of also challenge the status quo and ask, why not do it differently? Why not do it sooner? How can we get this? And I keep a pulse on what the lenders want, what clients want. We have cabs. I'm always talking to all of our clients, so we know what the needs are, where are they struggling, what can we do better as compared to any other vendor out there, right? We don't want to be just another vendor. We want to build for our clients, and that's been very critical for us as a company since the beginning. So we take feedback from clients very seriously. We always have a pulse on what do they need. Can we customize something? Can we build something new? And that defines the roadmap to a certain degree, where they tell us, hey, build this for us because this is absolutely needed for us to be successful as your client. So it's a balancing act, which traditional product management. You all do this.
I'm curious. I'm curious how that kind of enterprise, like B2B sales process goes, where it's like you guys must have such deep collaboration during the sales process, I'm assuming, but then ongoing after to be able to figure out everywhere you need to integrate. I'm guessing it's probably multiple systems with most lenders, multiple places in the process, certainly. How much of that do you, like? I guess what I'm trying to say is, do lenders know what they need when they find you, or do they kind of figure it out along the way during the sales process and during the onboarding process?
Great question.
I would
on our discovery process so many times. I don't know, Kirill can probably talk more to it, but it's an ongoing iterative process of how to do discovery well. And typically, if you do the first conversation with your lender, where you ask them all the questions and dig into, hey, what platforms do you use? What is your current, tell us your workflow. Mm-hmm. Some of these get uncovered upfront, and that gives me and engineering and product team enough time to say, we don't have this integration today, but we can build it, right? And if it's an enterprise lender who brings a lot of value to Truv, that's how we kind of prioritize it. Kirill, you were going to say something. Go ahead.
I would say it really starts with the early customers. The first few people who buy from a startup have to be a little crazy and innovative, and they're willing to try new things. And the first few customers that we have, I'm very lucky. I'm always grateful for having them, because they didn't know what they were signing up for. We didn't quite know what we were signing up for. And as a group, we kind of figure out as we went through it. And there are a few, first probably 3-4 customers for each product, were always like, look, guys, you just need to build this. And if you're as a B2B company, I think it's much different from consumer products. In B2B, if you're just willing to listen, I spend probably 40% of my time talking to customers and understanding where else can we build, they will tell you if you're willing to listen. And then you have to obviously execute, and without execution, nothing happens. The partnership doesn't happen. So building together is really, in co-development early on, was the big challenge. Now I think it's, yes, upfront we ask which POS, LOS you use, and we just check the box. Yeah, that's the one we support. And the changes are much more fine-tuning it specifically to your business today, like how many branches you have and how many loan officers you have. But early on, it was just all faith and goodwill between us and our customers.
And none of us came from sales, so we didn't know how to run discovery. We knew product management and engineering, how to do that well. So it was kind of learning curve for all of us, and we've constantly.
It is kind of interesting, because both your background in Darshana's background are so authentically not mortgage and not mortgage tech. And I don't. It doesn't really look too many, and that's probably a good thing. Don't be honest, because I think sometimes coming at it from what I call secular perspectives, like out of the mortgage church, if you will, sort of from secular perspectives, I think is really healthy, because when you raise the kind of capital you've raised, you attract a lot of tech attention, and you pull people from PayPal and Venmo and others that have. I say that because that's where Darshana spent quite some time with, but you have really bona fide technical credentials with a lot of your team, not too much within the mortgage space. Have you seen that? That has to increase your burn, number one, because there's a lot of learning that you have to do from because the mortgage ecosystem is really different than it is a standard tech company. But where have you seen that help you, and where have you seen that like hurt you? Would you say?
We rely heavily on our customers and our advisors. We actually haven't announced our mortgage advisory board, which we plan to do in late January. We have some incredible customers and incredible folks who've been like CTO and head of product and head of sales at large players in the space. And a lot of times they tell us what to do. So we're just, again, going back to the idea that you have to listen. Yes, originally, when you don't know what you can solve, sometimes that actually helps because you kind of like ignore all the rules and it's like, how do I solve this problem from first principles? But then first principles take you that far until a point where somebody tells you like, hey, this is not how it works here. Listen to me, this is what you should do. And I really appreciate some of the customers that we had earlier where it would be like, Carol, this is a stupid idea. Stop right now. Listen to me for the next 30 minutes. I'll explain you how you should do it. And then you decide if you want to do it or not. And that's been like the best blessing. Mortgage is actually not that different than a lot of other lending. Personal lending, auto lending is very similar in a way that it's just a manufacturing process, right? It's a marketing up front, and then it's manufacturing in the back end. And then manufacturing and mortgage is very different from all other industries because you have pretty much two largest buyers, not like and the two largest buyers define the rules. So if you cannot align with the largest buyers and you don't fit into their requirements, then you really don't have a chance as a business. So in personal lending, it's the same actually, and in auto as well. There's only a handful of players that matter, and everybody else is just playing by the rules. So
I appreciate that. One of the things we hear a lot is that mortgage is special, that it's such a big deal to the consumer. It's such a significant regulatory and financial commitment that even the manufacturing process is going to stay different or stay. And when I hear that, I mean, sometimes it's simply just hubris, but other times I hear it. And what I think I'm hearing is the implied gross income versus net income problem. Meaning I'm hearing them say, look, mortgage is always going to be gross income because Fannie and Freddie use gross income, and personal lending or auto lending is moving much more rapidly towards real income, what I call real income, net income. What's the cash situation? Can you talk a little bit about how much that should matter to a startup trying to attack this problem? Because on one hand, it's a philosophical problem that I can't let go of because it interests me. But on the other hand, it has fundamental implications for your build, for your product. And so how are you thinking about moving this industry or not away from gross income moving forward?
I'd say that both Fannie and Freddie are very innovative. They both have programs that understand the cash flow underwriting, similar to how fintechs do it in personal lending space, where you look at somebody's cash flow and you detect direct deposit. And in a lot of situations, if you see stable income, like for example, if every week you see like $3,000 or every 2 weeks, $3,000 post to your account, and then there's no variability and you have like, let's say, I don't know, 24 months of data, that pretty much means that net income of that person is $6,000 a month, and you can gross it up, right? Based on like, you can gross it up and you can estimate the gross income. And a lot of times, in a lot of situations, that would fit into the credit box, and you would be very comfortable with underwriting that consumer. Sometimes, if you see variability, 1 month I'm making 1,000, another month I'm making 18,000. That's probably when you want to stop and like ask for additional documentation, and that's what's happening in any space, actually, in any underwriting, because I think mortgage is not that different from subprime lending, where you look at score, and the subprime lending, the score just does not exist, or it's very low, and in mortgage it's high, but the difference is like the transaction is so big, and the uncertainty is so high that you need to verify income. And getting to income, you can get it through IRS, you can get it through a phone call, you can get it through payroll, you can get it through cash flow underwriting. And all of those methods together, that's the vision for Truv for the next like few years, is just to bring all those methods together so that you can always, for this specific consumer, select the best way to solve the problem of verification of income, so that the lender becomes comfortable and it's really easy for the borrower. So I keep hearing from mortgage lenders that everybody's spending a lot of time on underwriting, where everybody should be spending time is like marketing and sales and actually educating the customers. I think that's where the biggest leverage is. And manufacturing process should be semi-automated or as automated as possible. That's the vision. I think that's where the mortgage will be in the next like 5 to 10 years.
Sure. Jeremy, do you remember how we've talked about how a mortgage lender classifies income differently, right? Or how they should or potentially could classify income or assets differently than what mortgage lenders have traditionally done so, right? Like in the case of some of the test cases out in Silicon Valley, where you might have a $70,000 or $80,000 a year job, but you might have $4 million or $6 million worth of stock, but you still wouldn't really, but because it's an asset, it's illiquid. It might be it may not be it might be not vested or open to you for liquidation, but it's still there, right? But it's difficult to be able to leverage any of that, and more than often, most lenders would probably not qualify you for a mortgage because all they're doing is looking at the smallest part of your income, which is your W-2 income, right? So is there a way that a company like theirs could help? They're not defining the guidelines. They're not driving the rules. They're subject to what the lenders want to see. But if they're able to give a view of those assets in a more meaningful way to the lender, then the lender might be able to redefine those rules differently.
Yeah, 1,000%. I mean, I think the two sides of that coin, at least from my experience, are in order to actually look at a consumer, a home shopper, the way we want, it has to be holistic. It has to be holistic. It has to include everything, because that's how they're viewing their own life, right? If you go back to first principles, the customer is the homeowner. Well, I'll clarify this. I continue to look at the customer as the homeowner. In reality, the buyer of the RMBS is the customer. And so Fannie and Freddie want to do what's best for the buyer of the RMBS. That's actually how everything flows through this industry. But if you think about it from the consumer perspective, I have all of this about me I want you to consider. And when it comes to the income or the assets, how we capture all of this about a consumer is critical to who gets a house and why. And so if we do want to change some of how we pass through mortgage risk and sell mortgage risk to investors, we want to change that story or open up new opportunities for people to have houses in new ways, then we have to grab data in new and different ways. And one of those ways is saying, here's how you should be able to think about this. Most assets never got through to the end investor to improve that customer's profile because they were not documentable in a real-time way or in any kind of reassured way, verified way to the investors, to the underwriter and the investor. Well, technology is changing that, or has already changed that. So we can get real-time validation of what an asset's worth. We can use technology to continually update assets and income regularly in a program prior to you buying a house, so that you actually have some behavioral data. Like, all of those things exist. Now the question is, how do we connect the dots between those that make the decisions and buy the loans and those that actually are applying for it and deserve a house? And I think that's still one of the key disconnects in the industry. Truv's obviously addressing it. You asked the direct question was, are they addressing it? Directly. They are directly addressing it.
I've
never met either of you before, and I've actually never heard what the platform does before today. So in case anyone watching is wondering like where that came from, I'm just trying to keep up in this 45 minutes with where we're at and what the company does.
I love it. To add to that, what you're trying to do is you're trying to build like a P&L balance and cash flow statement, right?
For every person. Yeah.
For every person. And if you're able to build it with like high degree of certainty, including the forecasting of that P&L balance sheet and cash flow, I mean, there would be somebody who would buy that loan. Maybe not today, but then over a period of time, it gives like, if I only underwriting people who are in Silicon Valley making $80,000 but have $4 million in stock, I'm absolutely going to find enough investors to buy those loans off of my hands, and I'm probably going to be making extra profit. Somebody will hear about it, copy me, and so forth. That's how all the innovation works, right? And we're being copied, we're copying. It's like everybody is in the same kind of mix of solutions that are trying to address the same problem of like, how do I understand consumers' ability to pay? And hopefully we address it in a very eloquent and neat way for the lenders. So, if you guys want to know what Truv is, go to truv.com. We'll show you the platform around.
Darshana, when you think of what you need your customers to understand, if you're selling in to the customer or you're having your first conversation, particularly with a lender, what is it that is the key? What's the light bulb moment between your customers, our audience, and Truv that you go, that's what I need, that's what I needed to see, or that's the thing that tends to change the game?
Yeah, it's typically, goes back to the discovery to understand who are the different players, how do they use the system today, what are they doing on a day-to-day basis. So I typically start there and we ask, what is the typical LO use? Where do they go? What do they do? How do they use the products today? What is important to you? What data is needed by the underwriter, the processor? Understanding the different players and understanding how they use the system today is room where we can say, hey, we address all of this, or there are gaps in our solution. And that's where we didn't have invoicing, for example, in 6 months ago. And while talking to Revolution, one of our clients, they mentioned that, hey, this is really critical for us because we have different branches, and branches use your product, and we need to offload that cost to tell them, hey, this is what you're using. We don't want to kind of handle the billing. It gets very complicated. We also want to be transparent. This is our core policy and principles. So you need to understand what is critical to them and how they use our product or other products today, and see where the gaps are. And then from there, we obviously take an innovative approach to doing feature development. Again, whatever is easy to use. I come from B2C products, so I think deeply about how a user would interact with it, how a client would interact with it. It's almost like a marketplace where you have lenders and you have users. You need to build to both. You need to keep both the profiles in mind. You need to understand that some people may not be as tech savvy. Some people are super tech savvy. So based on the demographic, based on the type of the borrower, we have different interfaces. Like if you're a gig economy worker, when you interact with our product, it's different versus when you're a W-2 employee, right? And building that personalized experience is critical. So we dig deep, understand, and then solve for it. Solutions are easy, in my opinion.
Well, I love that too, because extending that one step further to allowing the consumer to have a place where they can go to keep their data updated while they're thinking, while they're shopping, while they're transacting, while they're in the home. It really becomes, I was talking holistically about the data picture of the consumer, but we really need to get to like proactive finance, where you're proactively giving these views and these insights to the consumer all the time. Why we don't, as an industry and financial services broadly, create that is that's a huge opportunity. That sounds really amazing.
I was waiting to see how you're going to get back to your proactive finance talking points, Jeremy. You made it. 1 minute to spare.
Yeah. If you're somebody out there, take a shot. Mike Kelleher is probably playing a drinking game with this. So there you go, Mike.
Yeah. No, I did love the concept of that 3-dimensional picture of the consumer financially, like kind of just the P&L of the consumer. Right now, it's so linear. It's so point to point, where I might have a W-2 job of $80,000 a year, but I might have 7 properties that have $6 million worth of equity, and none of that comes through because all I'm doing is verifying my W-2 source of income, and then I get denied a loan. It's almost like, and this is on your website, Kirill, where you said that when you applied your first job, you and I'm assuming it's because you were an immigrant, you had a credit score of 580. So you were basically just an underscored individual because you had no real credit history within the American system. So you had this I'm just throwing that. I'm assuming that was probably the case, as opposed to a divorce or all this debt you were saddled with or something. But the point is, you're 580. You're an immigrant, and there's a lot of immigrants in the country right now that might have multiple sources of income. They may not have the most clear credit picture, and they're really not getting the full revenue profile of the consumer when they apply for a mortgage.
Totally. And the good example is, I'm sure you guys heard of SoFi.
Yeah.
SoFi stands for social finance. It's folks from the same business school a few years ahead of me actually started it with the idea that, like, why don't we actually give better financing options for students out of like good schools, because they probably will have a good job. And that's like a bit of forecasting, not just like, tell me what's your credit score today and how much money you're making today. It's more like, it seems like you're going to make good life choices. So why don't we give you a bit of credit up front? And I think that's where, as lending becomes more and more commoditized, somebody who has either specific insights or some forecasting capability is going to be winning. And I think we're moving in that direction. I had actually a question for you guys. Since you're all coming from, as Rick said, from the mortgage church, why don't you tell us what we should be thinking about and what we're not maybe covered today?
Yeah, I mean, one of the things that the reason I was asking some of the questions is because we, especially on this show, but also just in general, brush up against like what's movable when, what and why something isn't at a moment in time movable versus not. And so I tend to really, I tend to create a lot of friction between the way it should be done and the way it is done. And so I think one of the things, when we think about, in particular, lenders' manufacturing price you brought up, or the cost of manufacturing that you brought up earlier, in part, it has to do with the number of integrations, the number of business partners, and the number of vendors you need to get from lead to delivery and everything in between. And so I think one of the things that I hear changing that you've sort of said, which is, how do I do one process or the same process to get the most amount of results out of it that I possibly can? The thing that I can't resolve is how these decisions get made at the lender tends to have a lot to do with budgets, the timing of existing agreements, and the fact that you've got to play like some sort of musical chairs with these agreements, when in reality, there could be a company out there that gets 13 to 15 of the things off the checklist. And yet I can't switch out 15 vendor contracts at the same time, and I give up. Or I do one, and then I'm using one company who can do 13 things for one thing because I wasn't able to really do what I wanted to do. And then we call that a win. And that is not a win. And so I think one of the things that I'm hearing, that I would suggest is like, how do we give a really, really strong, adoption roadmap to these institutions to say, no, this is not a problem. Here's how we're going to solve for it. Here's how we're going to give you everything you need in your toolkit. We'll figure out, how to deal with what's already in your system today, because otherwise we're just going to keep doing one modernization project a year or two modernization projects a year at each bank, at each lender. And that's never going to get us where we need to go, or at least not fast enough.
That's cool. Good advice. I like it.
We'll add some of that to our roadmap. I'm taking notes, and we have few pointers there. As coming into the mortgage industry with a fresh new perspective, I also see that there's so many handoffs and handshakes that happen through the workflow of a lender, which for me is like, why do we need that, right? It could all be automated. It could all be do we really need these individual kind of handoffs? that's something that we want to solve for in the future, right? Why can't we make it streamlined and more automated? Why do we need to have so many touch points with the borrower? These are some things that really fascinate me as problems and pain points that we want to solve for in the future. So we will solve for it in some way or fashion. It's all part of the roadmap without going into a lot of detail. But those are some key things that we think about day to day.
Right.
I think with my only comment would be, I love how you guys have drilled in deeply into income and assets and verifications. But the key is once you verified it, the key is accessibility to it, right? Mm-hmm. And so creating a digital highway, if you will, to make validating that information more easily, I think is the front half of the problem. The other half is access to that information, which just adds, once you've seamlessly pulled or been able to push those assets in a way where you can make better, qualifying either through payments or just through better qualifying criteria, I think you've solved sort of the back half of that problem, and I think you create a substantial revenue stream around just touching, because once you start touching the assets and you are part of the question of liquidity, then all of a sudden you're tapping into a much more substantial potential revenue stream because you're just dealing with a lot more money. But I think it's a path, right? It's a roadmap. I know Carta. I know you were the founder, or you were part of. I
was there and as an employee. I joined after the company was already very successful. I helped them get a little bit more successful, but but by no means I can claim any claim to fame.
Fair, but I think it's an interesting parallel as far as liquidity and assets. And I think that solves a great deal of the lack of visibility that a lender has in the financial footprint of a consumer, beyond sort of the traditional streams. But let me ask you this, and I'll say this sort of in closing, is there any play with realtors? Like if I'm dealing with a realtor, if I'm a realtor and I'm dealing with a consumer, this is sort of a layup for Brock, but if I'm a realtor and I'm dealing with a consumer, and I really have no idea if this person's worth $1 million or if this person's worth nothing, right? But I'm going to show them homes. Now, granted, I'm going to have a pre-qualification letter or whatever the case may be from a lender. In the effort of streamlining the whole view of the consumer for all parties at hand, is there a realtor play in the way the realtor understands their customer?
Yeah, I think yes and no. I think, for buyer's agents, they want to know as much about the financial position as possible, right? So they can maybe structure an offer in a way that it might be more likely to be accepted, make sure they're showing them the right types of homes, things like that. Especially if they have to use a different, like a non-conventional program. I think some integration there is helpful. But really, and Jeremy was at Rocket the same time as me when Rocket was kind of known that their pre-approvals were a little bit too quick and a little bit too let's say easy to get. And so then they the whole marketing campaign of verified approvals, and that's if you're gonna go see a showing, it needs to be a verified pre-underwritten approval, and then a fully underwritten approval, and then it's continued to step up. I don't know. I mean, it matters, but I still think a lot of it's a little bit lip service, and buyers agents don't care that much. One thing that Jeremy and I have gone back and forth on for a long time is what listing agents should get to see, because to some extent, I think Jeremy, you've defended in the past that you think that you think all listing agents need to see is like, can they afford it, true or false. But that's not how it works today. Listing agents end up getting a lot of information and making a lot of, let's say, controversial decisions on which offers to accept.
Oh. My view is that actually a financial institution's money is better than cash, honestly, because if you get a green light from a lender that there's money coming to the table and a national brand lender or local lender stands behind that, then actually that's more reliable these days with the technology we're building than the person who has to go to 7 different 8 accounts, grab the money together, put it together in the right way so that it can get wired in the right way to the table and all that. Is that actually if we had a trusted source, a more trusted source, that would actually be the way that real estate gets done. You shouldn't be able to discriminate between bank money versus cash or what type of lending is involved. I think that's actually bonkers. And it should be, can you bring money to the table or not? If we're paying deposits already, then it's on me to deliver the money to the table as a buyer anyhow. So I'll take that chance. You don't get to see where the money's coming from, and we pick the best structured offer.
Totally. I like this. Well, I guess lenders are better than cash, unless you bring the cash in the bag, which is like,
cash in a bag first. Lender.
Yeah. Last time I bought, we bought a place in Miami. There was literally somebody who beat me on the offer, who literally brought a bag of cash.
People in California, they actually bid all cash offers. True story.
Cash.
Kirill, you're Russian, right? Or we're
I was born in Russia. I'm like half Russian, half Ukrainian.
Yeah. Well, there's that section between like Boca and that's like all Russian. That's like little Russia. So if it was a bag of cash, I'm not surprised. Okay.
I don't go there. That's a scary neighborhood. Like.
Well, good. Well, we appreciate having you and Darshana. As guests, we'd love to have you back as progress. You guys realize progress, and it's always good. This is the intent of Real Fridays, is to have an open conversation. One thing that Darshana asked was, can we have some sort of questions in advance? And I was like, no. This is about a conversation around three areas of the business, like the realtor, the tech, and the front end retail side of it, and we sort of expand around that. But it was really good to meet you. It's good. I met Darshana at one of the MBA conferences, and it's good to meet you finally. This is you guys have raised a ton of cash, and so good for you guys. Hopefully, don't spend it all at once. Keep that burn at a minimum.
We're not putting everything on red. We're actually I think we're trending to be more of a sustainable business pretty soon. So it's trending in the right direction. Guys, absolutely pleasure to meet you all and spend some time with you on Friday. This was
absolutely.
Thanks for having me.
Thanks for joining.
Thank you guys.
Nice talking to you. Thanks, Darshana. Thanks, Drew.
Bye-bye.